So the most important thing that we also want you to identify is, obviously, if you have a financial advisor, we want you to be empowered. We want you to understand basically what's out there so you can make a decision for yourself and not get ripped off. Because unfortunately, a lot of times people get ripped off and they don't notice it. So thinking like an investor. When I think as an investor, there's certain things that come to mind. Dale Carnegie once said, take a chance. All life is a chance. The man who goes the furthest is generally the one who is willing to do and dare. One of the biggest mistakes that a lot of savers make, or investors, is that they're afraid of risk. And risk is a part of life. You have to be able to accept it, and you have to be able to take it on in order for you to plan effectively for your retirement and to allocate your assets effectively to become an effective saver. This goes on to another one of my favorite quotes, which is a Russian proverb that goes, "He who does not take risk never gets to drink champagne." So I don't know about you, but I'm young. I'm 22 years old. When I get old, I want to be able to be drinking a lot of champagne in my villa somewhere in Milan. We'll see. And lastly, one of my favorite authors, Oscar Wilde, he always says, when I was young, I thought that money was the most important thing in life, which I do. Now that I'm old, I know that it is. So obviously you want to be able to have enough money so you can live effectively and not have to worry about, okay, am I going to have enough money to pay some expenses this month or so on and so forth. So the most important thing that we want you to get out of this is that saving and investment is equal to the same thing. If you study economics, you're going to realize that saving is equal to investment. That's one of the primary formulas in economics. And that's a misconception that people have. They don't think that investing and saving are the same thing, but it really is. It's not just putting money in a bank as your savings account is saving. Investing is another form of saving, and we want you to realize that. So I don't like risk. You might tell yourself, hey, I don't like risk, Mike. I don't think it's a very good idea. Well, that's too bad. Risk is a fact of life, and no risk is equal to a big risk. You're going to limit your returns by not taking on risk. One of the biggest risks that we have out there is inflation risk, which is a general increase in the price level, right? A general increases in prices. Like if you've seen the gas prices right now, they're pretty high. That's a risk that you're taking by not investing your money effectively to hedge against inflation in the market. So an introduction to risk. So we want to get an idea of what really is risk. If you ask any financial professional, they're going to tell you right away, okay, you have this bell-shaped curve and you have standard deviations, so on and so forth, and different standard deviations mean a certain level of risk, and down here is your downside risk. This is your upside risk. But what I like to think, this is kind of boring. Because people don't really identify with this. It's not, I don't know about you, but most people are not going to put in an Excel spreadsheet, mathematical formula. You want something for you that's simple so that you can understand. So what's this risky business? And it's not Tom Cruise that we're talking about. There's different definitions. Like I said, one of the main definitions is standard deviation, which we did mention, which is this formula, but it's not going to be relevant to us right now. We also have opportunity costs. Hey, I should have invested in this. That's a risk some people view. You also have a bad outcome, a negative outcome. That's a definition of risk. It's one of the oldest definitions. Or, if you've been watching the news for the last month or so, Charlie Sheen. That's another risk. That's a big deal. But what we really care about is downside risk. What's the risk that I'm going to lose money? And each of the financial products and instruments carries a certain degree of risk that you need to be aware of. They carry a certain degree of volatility that you have to be aware of. So the first instrument that I'm going to cover is Treasuries. And Treasuries are one of the most widely used financial instruments out there. You have three kinds of financial instruments with Treasuries. You have the T-bills, you have the T-bonds, and you have the notes. Basically, what makes them different is that T-bills are short-term instruments. As it demonstrates here, they're from 4 weeks to 52 weeks. If you have T-notes, they're anywhere between 2 to 10 years. Bonds, long-term bonds, are issued for 30 years. And TIPS, which is Treasury Inflation Protected Securities, they range from 5 years to 30 years. So basically, those securities, they adjust for the level of inflation in the economy. So I'll give you some characteristics of T-bills. T-bills, they're known as zero-coupon bonds. And what's a zero-coupon bond? A zero-coupon bond is basically an instrument that doesn't pay any interest. They sell them at a discount. For example, a zero-coupon bond, they will sell it at $80. And at maturity, at the end of its life cycle, it's going to mature to $100, for example. The interest rate that you get is obviously 100 divided by 80. And that's basically what you're getting in interest. So they don't pay you a fixed interest, they basically pay, you buy it at a discount and it matures at face value. They're considered to be risk-free. And why do I say they're considered to be risk-free? The reason why Treasury bills are considered to be risk-free is that who issues them? The government, exactly. So the government usually doesn't go bankrupt most of the time, the federal government. Why? Because they have two primary powers that everybody else doesn't have. They have the power to tax. So if we need to pay our obligations, we just say, no problem. I'll just tax you at a 60% rate. How's that sound? No problem, right? That's one way that they can reduce their obligations. Or they can also print money. There's the Federal Reserve, and basically what the Federal Reserve does is it prints money. So, I mean, that's going to allow them to pay off their obligations. They historically have returned 3.7% from 1926 to 2005. So if you look at the compound annual growth rate, if you would have invested in a Treasury back in 1926, you would have gotten compounding, right? 3.7% per year. That sounds really nice right now. But obviously there's risks entailed in that, so I'm going to show you that right now. They're highly liquid. They're practically cash, so it's a cash equivalent. And one of the things that you want to know about Treasuries is that you can buy them, anybody can buy them. Their minimum investment for a Treasury is $100. They're exempt from state and local taxes, and you do have to pay federal taxes. So that's important. But there's a few ways that you can go about buying Treasuries. There's three main ways that you can go about buying them. One of them is if you have a broker, like if you have a broker like TD Ameritrade, if you have like Scottrade, you can actually submit an order to your broker, hey, I want to buy a Treasury bill, I want to buy a Treasury note, I want to buy a Treasury bond, and you can submit it. That's one way that you can buy it. Another way that you can buy it is also through the Treasury's website. The Treasury has a program called Treasury Direct, and basically what the Treasury Direct does is you can set up an account there, and it's going to allow you to buy Treasuries directly from the Treasury's website. And obviously you avoid commission fees of a broker. You can also buy it from your bank as well. Banks will also sell you Treasuries. So if you have like a Chase account, so on, you can ask them, hey, I want to buy a Treasury. Now, the Treasury yield right now is very low. So if you look at what a Treasury bill gets you, it's only going to get you about 0.03. So for every 4 weeks, you're going to get 0.03%, which is very, very low. It's probably lower than your bank account right now. So that's not very good. If you invest in something like a Treasury bond, you're going to be able to gain anywhere between 3 to 4%, depending on what's the length of the bond. So it's 3 to 4% that's trading right now. But one of the biggest risks that you have with Treasuries is inflation risk. And they can either be held to maturity, by the way, and they can also be sold prior to maturity. So you don't have to hold the Treasuries until maturity. You can actually sell it. And the benefit of them is that since they are practically cash, you're basically going to get your principal back most of the time. However, with the fluctuations in interest rates, you may not get your principal back all the time. So, what's the catch of investing in Treasuries? They're practically safe. They don't default. I can get a nice 4% Treasury bond. It's no big deal. Well, low risk also means low return. There's a relationship between risk and return. And one of the biggest risks, as I mentioned, is inflation risk, price risk, and interest rate risk. These are all hand in hand. So I'll give you an example. Interest rates and prices of the Treasuries, they have an inverse relationship. So let's say if the price of a Treasury, $100, it's $100, right? And it has a 10% interest rate, right? Let's say if interest rates go down, right? Let's say if interest rates go down, then in order let's say 8%, right? In order for that Treasury bond that's 10% trading at 10% right now, to match the 8%, the price has to go up, right? So if interest rates go down and you're holding a Treasury, then that's fine because the prices are going to go up and you're going to get compensated that way. Do you guys have a clear picture of how that works? No? Okay, let me give you an example. Let me put it on give you an example on a calculator. All right. Let's take a look here. Okay. So let's say that you have a Treasury that's trading at 8%, right? So at 10%. So 10 over 100 is equal to 10%, right? Now you want to have 8%. That's the yield that's in the market. The market is yielding 10%. So basically you want to find out what's the price. So 10 divided by 0.08 is equal to 125. If you divide 10 divided by 125, that's 8%. Basically what I'm showing you right now, let's say the market interest rates go down. The price of that bond, the Treasury bond, has to go up, right, in order to match the interest rate in the market. So for example, what's your name? Cheryl, what's your name? Lydia. So let's say Cheryl has a 10% Treasury bond. It's paying 10% right now, right? And for some reason, the market changes and the interest rates go down because the economy is not doing so well. The Federal Reserve lowers the interest rate, right? So the market rate is 8%, right? Cheryl, right? And Lydia. Okay. So Lydia says, great, I want to go out in the market and I want to buy a Treasury, right? So she goes up to Cheryl and says, hey, Cheryl, I want to buy that Treasury from you. It's 10%. That's nice. I'm getting a rich interest payment. Let me buy it from you. Now, but Cheryl's a smart girl. She's not going to give it to Lydia for $100. Why? Because Cheryl says, hey, look, I have a bond that's paying me 10%. The market rate is 8%. In order for you to compensate me for that interest rate discrepancy, I'm going to charge you more money. Now, Cheryl is going to keep on bidding up the price until it equals 8%. Why? Because let's say if the interest rate that Cheryl's offering to Lydia is lower than 8%. Lydia is going to say, hey, I'm not going to do business with you. I can go to somebody else and they're going to give me 8%. Does that make sense? That's basically the relationship that's a bond. That's how a bond works. There's an inverse relationship when you look at bonds. So, okay, let me go back to the slide. Okay. Let's go forward. Okay. All right. So, another important risk that you have to consider is inflation risk. So, to give you an idea of how inflation risk works, let's say that you have a Treasury that pays you 10%, right? So for $100, it's not working. I guess I have bad luck. All right, let's say that I have one Wellington. So let's say you're getting a 10% rate off that Treasury. So the minimum investment, once again, is $100. For each of the Treasuries, it's $100, the minimum investment. So I'm getting paid 10%. Now let's say that the prices in the market, or the inflation rate, is 4%. Does anybody have an idea what your real yield is? What the real yield is? This means that you're losing 4% purchasing power. This means that you're gaining 10% purchasing power. So in essence, your real yield is 6%. You see how that works? That's basically what you need to be aware of, because right now, let's say you buy a short-term Treasury instrument. If you look at the annual yield for a short-term Treasury instrument, it's going to be less than 1%. But if you look at the inflation rate, year over year, it's greater than 2%. Right? So your real yield is what? Negative 1%. And the reason why that is that the Federal Reserve wants you to spend, wants you to consume, because they want to upstart the economy. They want you to take money out and spend it. So they're increasing the opportunity cost of putting your money in something like Treasuries. So you need to be aware of that. Whatever the inflation rate is, you need to factor that into your investment, because inflation erodes your earnings. It erodes your yield. So that's something that you need to be cognizant of. So that's why I say you have inflation rate, and inflation risk is a big deal. Another risk that you have is obviously interest rate risk. That same benefit that Cheryl had when the interest rates went down can work against you. Because let's say that the interest rate goes up, what's going to happen to the price of that bond? Yeah, the price of the bond is going to go down to plummet in order to match the interest rate. So that same effect that worked for Cheryl and didn't work for Lydia now has the opposite relationship. It's not going to work for Cheryl anymore. So you're going to lose some net worth because of the effect of the interest rate. If the interest rate goes up, the bond has to go down. That's the way it works. So just to give you a little quiz, right now the interest rate environment is a very low interest rate environment. So the question for you is, let's see how smart the employees here are. Do you want to be in bonds? Do you really, really want to be in bonds? How many say yes? Okay, how many say no? How many are not sure? How many of you want me to manage your money? Okay, you really don't want to be in bonds. Okay, the reason why I say that is since we have a very low interest rate environment, the interest rates have to go up. They're practically at zero with the federal funds rate, 0 to 0.25%. So because of that, everybody knows that bonds are going to go up. The interest rates are going to go up. And when the interest rates go up, the value of your bonds plummets. So that's something that you need to be very aware of. That's why in 2008, 2009, that was a great year for bonds. Because what happened to the interest rates then? They all went down. Because obviously the government wanted to stimulate the market. And it was perfect to be in stocks. Because stocks were trading at a really, really cheap price. Now, bonds are more risky because of the low yield. And that's something that you need to consider. So it's price risk and inflation risk and also interest rate risk. Interest rate and price risk are practically the same. They just have an inverse relationship. So that's something important to consider when you look at, that's a catch when you invest in a bond or treasuries. So the next instrument, we're going to look at bonds. I mean, we already looked at government bonds, but now we're going to look at some other kinds of bonds that you might find interesting. So what are bonds? Or what are corporate bonds? Am I talking about Barry bonds? I don't think so. Am I talking about James Bond? Not a chance. Am I talking about bail bonds, Dog the Bounty Hunter? Not. That's not what I'm talking about. I'm talking about fixed income investments. And the reason why they're called fixed income investments is because traditionally, when you buy a bond, it pays you a fixed coupon. They tell you here, I promise you I'm going to pay you 10% per year, 5% per year, whatever the rate is on that bond. Make sense? And a lot of these bonds, they have different, they're attached to different kinds of assets. For example, if you buy a corporate bond, it's attached to the earning capacity of a company. So that's a way of thinking about it, that you're being paid based on how much the company generates. But they generally promise you a fixed income investment. That's how they work. However, there's some, instruments that you can buy. Bonds, if you want to invest in a bond, the minimum investment usually is $5,000. So if you go to Thinkorswim, which is a kind of like, it's based off TD Ameritrade, it's a broker. If you want to invest in bonds, the minimum investment is $5,000. So that's just something that you have to be aware of, the minimum investment. They come in different flavors, such as high yield, corporate, and municipal. High yield bonds are known as junk bonds. And the reason why they're called junk bonds is they operate just like zero coupon bonds. Back in the 1980s, there was this famous financial engineer, Mike Milken. If you heard of him, he's the junk bond king. That's another nickname for high yield. And basically what he discovered was, he said, hey, look, I looked at all these companies and I want to see which is the better investment. We have all these AAA rated bonds that are the highest rating. Everybody wants to invest in those because everybody knows they're safe. But he had an idea. He said, wait a second. I want to invest in a company that's a fallen angel. A company that's not AAA rated, that's not the highest rated. It's C or lower than C. That's not investment grade. That has missed an interest payment. Why? Because he can buy it at a discount, and when maturity comes along, he's going to get paid the full amount. That's another thing that I also want to mention. With any kind of bond, it pays you a fixed investment, like a fixed interest rate. At the end of the bond's life cycle, it's going to pay you your principal. So let's say if you bought a treasury, you invested $100. At the end of the life cycle, it's going to give you $100. Make sense? So you're going to get, obviously the 10%, for example, and at the last payment, you get 110. Because it's 10%, which is the interest payment, and $100, which is the principal. Okay? Okay, but so anyways, high yield. The way that high yield works is a zero coupon bond. It doesn't pay you an interest. It pays you, obviously, a maturity. You get the same way as the treasury bill. Corporate bonds, obviously, they're issued by large corporations and small corporations, and they basically vary. So if it's a big corporation, it tends to be safer, relatively safer. So if you're investing in a company like Procter & Gamble and you want to buy a bond from them, they might have a bond that's like 3% or 4% or whatever it is, right? However, let's say you buy a bond from a smaller company, like a tech company like Ebix, right? Very small company that's a startup. Which one are you going to ask a higher return from? The large company or the small company? Exactly, the small company. Why? Because a small company is a lot riskier. It may not pay you. So you're going to ask a bigger rate of interest in order to compensate you for the risk. Okay? Now, most bonds, they pay interest semi-annually. That means that they pay interest twice a year. So they pay one half the year and the other half you get the other interest. So if you have, let's say, that 10% example again, you're getting paid $10. The first half of the year you get $5. Second half of the year you get the other $5. That's a convention. Usually bonds pay interest semi-annually. And they've historically returned 5.9% from 1926 to 2005. So that's to give you an idea of their compound annual growth rate. So as I mentioned previously, Some of the advantages of bonds over stocks is safety. They tend to be a little more safe because they're a lot safer. They have a reliable income, so you're getting paid a fixed income every month. Stocks don't have to pay you a dividend. Some stocks don't even pay a dividend at all, so they don't have a reliable source of income. You have the potential for capital gains as well, so if the interest rates go down, then obviously your bond price goes up. And that's going to give you an ability to sell your bond and get a capital gain, okay? You have diversification because you also want to diversify your assets. Usually when stocks go down or stocks go up, bond prices fall and vice versa. So when stocks go down, bonds go up. They become relatively more attractive. So they have an inverse relationship. Now, some of the risk of bonds, they're less risky than stocks, but again, they suffer from the same risk as treasuries because treasuries are a type of bond. And some of the risks that you have, which is liquidity risk is a big one because bonds don't trade on an exchange. So like if you see up there, we have obviously the S&P 500 and all the stocks that trade on the New York Stock Exchange, so on and so forth, right? Those trade on an exchange. But bonds do not trade on an exchange. They trade over the counter, meaning there's a group of dealers that sets the price. So it's not you might not get the same prices as you paid for. So if you paid $1,000 for a bond, let's say if you want to go back tomorrow and sell the bond, you might not get it. You may get $900 because there's not such a big market. It's not a very liquid market. Exchanges are very liquid. There's a lot of buyers and sellers. So you have a good chance of getting back your principal. There's call risk and reinvestment risk. Some bonds have a provision which is called a call provision. So let's say if the interest rates go down, let's say if a company issues a bond at 10%, right? And interest rates fall down to 4%. Some bonds have a provision called a call provision where they can buy back your bond and reissue the bond at a lower interest rate. Now the problem with that is this, that let's say that the interest rates go down. Now if you want to you're hoping that you're going to get 10% every year. Now when you go to reinvest it, what rate are you going to get? 4%. So that's reinvestment risk. That's a very important risk that you need to be aware of. And if you're investing in foreign exchange bonds, bonds that are from a different country, like in China or Australia, so on and so forth, you may have foreign exchange risk to contend with. So that's important. Now, if you look at the base, this is basically a pyramid of risk. The lowest risk is government bonds, CDs, notes, cash equivalents, money market, bank accounts. That's low risk. Middle risk, you have real estate, equity mutual funds, small cap stocks, high income bonds and debt. So this is below equity, any kind of real estate, so on. And the highest risk that you have is options, futures, and different kinds of structured notes. So that's just to give you an idea of how the pyramid works.
I think it's important to summarize what we have so far before we start moving on. Is that basically there's an inverse relationship. It's an inverse relationship in terms of returns and risk. The more risk you take, it's a direct relationship. The more risk you take, the more potential returns that you can get. So when you start looking at different instruments, like the ones he was mentioning, the treasury bills, the treasury bonds, the corporate bonds, you need to have that relationship in mind. You need to be aware of that by buying a treasury bill, you have a low risk because most likely the government is not going to default and it's almost guaranteed that you're going to get your money back. But it's also important to know that the reward that you're going to get is smaller than if you had another instrument. Same thing with the bonds, with the long-term bonds and the corporate bonds. If you were to compare these three asset classes, you will find that the corporate bonds are the ones that pay the higher return historically. As he mentioned, it's something close to 5 or 6, correct? Yeah, something close to 5 to 6, which is 3% higher than the bills and the bonds. So that you need to keep that in mind. So, and when you start asking yourself, you need to look and start thinking, do I want to be more conservative? Do I want to take a lot of risk? Or do I want to be more of a safe haven? So if you think yourself, I want to take that much risk, I want to make sure that I have my money when I need it, maybe you want to start looking at different instruments and when you are making your investment decision.
No, that's very well put. So, I mean, if you get out anything from today, just remember that there's a relationship between risk and reward. The higher the risk, the higher the reward. So it's a direct relationship. That's the most important thing that we want you to realize here. But obviously, you can diversify your assets in such a way that you can adjust, you can actually make it smooth out your risk. So that's important. Another risk that I want to mention about bonds is bankruptcy risk. And this is something that I didn't mention. But, unlike the government, corporations can go bankrupt. They can actually go bankrupt, and you may lose your principal, or you may lose part of your principal. But the good thing to know about bonds or corporate bonds is that, let's say if you have a senior level debt, there's different levels for debt. There's senior level, there's junior subordinated debt, so on and so forth. If you have a senior bond, you're higher in the chain of command, in the line of command during bankruptcy. So, in the line of liquidation. So that's something that's important to note. Okay, so another financial product that we're going to go over, which is my favorite, this is my specialty, at least I like to believe that, is stocks. And this is the most famous financial instrument because every time you ask somebody about financial instruments, they're going to say, okay, well, stocks, what kind of stocks you have? Oh, I heard about the stock going up. Because you see it every day in the news. Right over there, you see in the news on Bloomberg TV, it's, stocks. That's what's going on. Now, basically what stocks represent is common ownership rights. So you own a share of the company. And there's two ways that you can make money from stocks. You can actually get dividends or capital gains. And that's important because, obviously companies that are dividend paying stocks, they tend to be a little more conservative or they're in a mature industry. Capital gains are for companies that are going to grow rapidly. So you want to gain money from the appreciation in the stock price. If you look at stocks, they have historically returned 10.4% from 1926 to 2005. So they have obviously that one of the highest returns out of all the asset classes. And these are common shares. We have another share of stock that's called preferred shares. And preferred shares are hybrid equity and bond instruments. And what do I mean by that? Basically, a preferred share, essentially what it does is that it behaves like stock, but it also behaves like a bond. A company promises you a dividend. They say, okay, you have a preferred share. I'm going to give you 5% every year, a dividend every single year, right? However, just be aware that preferred shares, they don't have to pay you the dividend. So you may get a higher return than the bond, but they may not pay you that payment, that dividend payment. You understand? Is anybody lost, or you guys want me to explain it again? Or okay. So basically, in order to compensate you for the greater risk of not being paid, the company is going to promise you a higher interest rate. But once again, you may not get paid that dividend. However, some preferred shares have a covenant where basically it allows you to, the dividends accumulate. So if a company skips paying a dividend, then you actually may get paid a dividend the next, so on and so forth. So the dividends accumulate. Most of the dividends are like that. But companies don't tend to issue preferred shares because they don't get any tax benefits from it. They really don't. They get, if a company issues a bond, the interest is tax deductible. If a company issues a preferred share, the interest is not tax deductible. Usually, companies that are about to IPO or go out into the market or to have shares on an exchange, they have preferred shares. But most of the time, companies try to shy away from that. Another important concept that you need to know about preferred shares is you have no voting rights. So common stock, it gives you voting rights. You can vote on affairs of the company, the management, the board of directors, so on and so forth. But preferred shares, in order to, you trade that off. You give up voting rights for a promised or fixed rate of return or a safer rate of return. So that's important. So what are some of the financial risks and benefits of investing in stocks? As I mentioned to you, yes? Okay, I can go over that for you. All right, I'm going to give you an example. If you look at the bottom here, I have Intel and Juniper Networks, right? Intel has been a company that's been around for quite a while, and they pay a nice dividend. They pay anywhere between 3 to 4%. They're a company that's in a mature industry, and it already has a lot of cash. So this company is a very mature company. You see what I'm saying? And what ends up happening is that these companies, they don't have anything else that they can invest that money in. They've exhausted all the opportunities within the company to invest that excess cash. So they have a surplus of cash. So instead of having that company, having that cash wasting away in the company, they tell themselves, hey, I'm going to give this back to the investor because you can figure out a better way of investing that money than I can. Does that make sense? Because they've already exhausted all their opportunities for investing the money. Does that make sense? That's usually a dividend-paying company. But they don't always pay out everything in dividends. They have different payout ratios. So sometimes companies only pay like 30% or 10% or so on and so forth. But eventually companies, and this is financial theory, that they're going to issue a dividend eventually. One of the most common models that people use to value companies is called a dividend discount model, and it's predicated on the assumption that a company is going to pay a dividend. For a company that doesn't pay a dividend, they're a little bit harder to find out the fair value. Now, for a capital gains company, to go over that for you, this is a company called Juniper Networks. They're in the same industry as Cisco, and basically what they produce is routers and switches. They produce a technology for that. Now, this company doesn't pay a dividend at all. So as an investor, you're going to ask yourself, why would I bother investing in a company that's not going to give me any money, right? Well, the point of investing in this kind of company is that you're going to hope that the share price goes up. So right now it's trading at, like $60 or $55. You're hoping that it's going to go up to 70 or 80 or so on and so forth because you have confidence in the company. Or eventually you think the company is going to pay a dividend, a nice dividend, once it gets big enough. The problem with that is that you take on some degree of risk. Because let's say, something happens in the market and the price falls, obviously you have to take the brunt of that risk. Not only do you have to take on that risk, but obviously you don't have income coming in. So you literally are setting money aside that's not working for you. Not that it's not working for you, but it's not giving you any revenue coming in. Okay? Do you understand that? All right, great. So let's move on to the next one. So, like I said, common stocks, they come in different flavors. You have dividend-paying stocks, capital appreciation. You can buy stocks in technology. You can buy stocks in consumer staples. You can buy financials. You can buy real estate investment trusts. There's tons of kinds of equity instruments out there that will suit your investment needs. So obviously, this does involve a greater degree of research if you want to invest in this because there's a greater degree of risk when you buy into stocks. The big risk that you need to know is something called systematic, unsystematic risk, and the volatility. So if you look at systematic risk and unsystematic risk, basically what are those concepts? Well, systematic risk is a risk that you cannot escape. It's a reality. If all of you saw what happened in 2008, the whole market started to crash, right? So when the whole market crashed, every single asset class, whether it was stocks, commodities, even bonds to some extent, to some degree, they all fell in value. Why? Because that's a risk that's inherent in the market. You cannot escape it. Systematic risk, you cannot diversify it away. It will always be there. And that's what I mentioned earlier, that risk is a fact of life. If you don't like risks, that's too bad because you really have to deal with it. Okay? Whether it's inflation, whether it's systematic or unsystematic. Now, unsystematic risk is an interesting form of risk. It's a risk that's just solely in the company. And to give you an example, let's say you have two companies. I'm going to give you Burger King and McDonald's, right? Or let's say Wendy's and McDonald's because Burger King is not traded on an exchange anymore. So let's say Wendy's and McDonald's, Yum Brands and McDonald's. McDonald's gets their meat from, let's say, Texas. High quality grade meat, Tennessee, Black Angus, great. I mean, we know that's not true, but let's just assume that it's true, right? Now you have Wendy's, and I'm not saying anything bad about Wendy's, so don't take this as a solicitation or anything like that. But let's say Wendy's gets their meat out of somewhere in South America, Asia, and it's poor quality meat, right? And the investors know this. The investors know that, okay, the meat comes from this location. Let's say something happens where the meat in Asia and South America goes bad, or there's mad cow disease, and now the consumer in the U.S. is saying, hey, I don't want to eat meat that comes from this location. So what's going to happen to Wendy's profits? They're going to drop. What's going to happen to the stock price? It's also going to drop. So that's something that you need to be aware of, right? But what about McDonald's? You might say, hey, McDonald's has meat too. They're a fast food company and so on and so forth. But the investors are not dumb. The investors know, hey, McDonald's gets their meat high quality from Texas and Tennessee, Black Angus, so on and so forth, meaning that they're not going to be affected by this meat crisis. You see what I'm saying? So the answer to your question of what is unsystematic risk, it's risk that's solely in the company. And you can diversify that away by having a basket of stocks or a basket of assets. Okay? Make sense? And another problem with stocks is they're last in line during liquidation. So if you were unfortunate enough to hold Lehman Brothers stock in 2008, you probably wouldn't have anything today. So that's, obviously a risk that you take. But once again, if you hold a basket of stocks, you diversify your asset pool, then that risk is minimized because you're not putting your eggs all in one basket. Okay, so just to go over some, recap on some of the concepts we went over, the income portion is dividend paying stocks, masters of limited partnership, real estate investment trust. Growth portion is usually companies that are growing very quickly. They're usually tech companies. Most of the time you'll find growth companies are tech companies, or companies that have a very small market share that are expected to grow. Microsoft and Apple were a growth company back in the 1980s. Now Microsoft and Apple are mature companies. Even though Apple is still considered a growth company, Microsoft is now considered a very mature company. So now it's paying a dividend. You see the difference between income and capital appreciation? So investors are not going to expect Microsoft to grow really quickly because it's very mature. Now, masters of limited partnership and real estate investment trusts are very important financial instruments that people don't know about. And the reason why I stress these is that you guys would really want to invest in this. And why do I say that? Is because they give you a very high yield, right? You see this guy in the bottom, he's chasing yield. He wants to get that percentage, right? Now, what these companies are designed to do, they're based off a law that they have to distribute 90% of their earnings in the form of dividends. So a masters of limited partnership or real estate investment trust, by law, has to issue 90% of its earnings in the form of a dividend. And one example of a master limited partnership, which we hold in our portfolio here in the at this lab, is it's called Kinder Morgan Partners, right? KMP. And their yield is almost 6%. So that means that you're getting 6% on your money. And that's a good deal. Obviously, you take on some degree of risk because it is an equity instrument. But by law, they have to pay out 90%. So you get a nice fat income coming in. So you might want to look into that. Our real estate investment trust is very similar to a master limited partnership, except these guys focus just on real estate. So they invest on real estate, they make money off their real estate, they lease out properties. You can make a lot of money off, having your own REIT. There's a lot of them. But they have to pay out 90% of their money, of their earnings in the form of a distribution. So that's important to know. Now, when you do receive a dividend, you have to also be aware of the tax implication. It's taxed at your tax bracket. So that's important to know. Or, let's say you have stocks and you have to pay a tax liability and your stocks have lost money. You can actually sell off your stocks, take on a capital loss, and that's going to reduce your tax liability. So if you're ever in that position where you have stocks or any kind of financial instrument that you're losing money, you can sell it off and take a loss to reduce your tax liability. So that's something that you might want to have in your tools, to obviously manage your tax liabilities as well. Growth companies, we already went over that. So basically, you want to buy it at 29 and you want to sell it at 35 or 36, as high as possible. But remember, they don't usually pay a dividend, so you also have to take that into consideration. Okay, so once again, taxation and fees. If you have a stock and you've made a capital gain, if it's within less than a year, you have to pay your regular tax bracket. So if you're in a 35% tax bracket, 30%, so on and so forth, if you sell your stock within less than a year, you have to pay within your tax bracket. Okay? However, if you keep your stock for more than a year and you make a capital gains, you only have to pay a 15% capital gains tax. That's how taxation works for stocks. Any questions? No? Are we learning something or not really? Okay, so that's something that you want to consider when you purchase stocks. You need to consider your tax implication. Broker commissions. This is very important because a lot of times when you buy a stock, you have to have a brokerage account. And the way the brokerage account works is that you set up something with Thinkorswim or TD Ameritrade or Scottrade or whatever you feel comfortable, Zeco or whatever it is. But you have to keep in mind that these brokers are not a charity. They're not going to do it for free. They're going to charge you a fee. So sometimes they have a structure where it's flat fee trading, where they say, okay, we'll charge you $9.95 per trade, right? That's good if you're buying a lot of stocks or a big portion. Or they have another system. It's a per share commission. It's a 0.0015 per share, very small amount. So it's 1.5 cents if you want to have that fee structure. And you can obviously tell the broker, I prefer this fee structure, so on and so forth. And you can shop around. Different brokers have different fee structures. But one of the things to note about choosing a broker is that sometimes they have disadvantages in the sense that you might have a discount broker that's a very, very simple layout. It doesn't do anything for you. You can have a full service broker where it gives you, obviously reports and fancy charts and all that stuff. So it's up to you on your investment needs on which kind of broker you want to use. Another disadvantage is that sometimes brokers are a little slow at placing orders. Some brokers are faster, some brokers are slow. So let's say if you see a stock that's trading at $10 a share, you say, okay, great, this is a great price to buy it at, right? You submit the order. But what happens? The broker is really slow at processing the order. You might not get the $10 a share, you might get $12 a share. So even though you may get a low, commission fee, you also have to take that into consideration. You may end up paying more in the end because, of the broker and how the broker, the quality of the broker. And you can call the broker and ask them those questions. You say, hey, look, I'm shopping around for a broker. Can you tell me how this works? And they'll explain to you in the commission structure and how fast they are at filling orders. That's very important. It's important when it comes to fees. Oh, and OTC pinks. I don't really recommend investing in companies that are penny stocks. A lot of people, I hear it all the time here in the lab, especially people my age, like, yeah, I just made $2,000 or $4,000. I bought this penny stock that was trading at 5 cents a share. I don't really recommend that because they trade over the counter. And over the counter, obviously, what I mentioned before, what happens with over the counter, you don't have a lot of liquidity, meaning that you may not get the same price. So it may be 5 cents now, 5 seconds later, maybe 2 cents. And you've lost a lot of money if you have a lot of money invested. So I don't really recommend investing in over-the-counter stocks that are penny stocks. But if you want to do it, they generally have a higher commission fee, $9.99 per trade. So that's something to consider. Okay, let's see how much time we have left. I'm going to go over really quickly mutual funds and ETFs, and then Wellington's going to go over asset allocation. And then we'll recap. So mutual funds, what are mutual funds? You hear about it all the time. There's different kinds. There you have obviously Franklin Templeton, you have PIMCO, you have MFS. Which one do I choose, Mike? I don't know. I'm not really sure. But let's educate you a little bit on how a mutual fund works. Basically, a mutual fund, what they do is they're an investment pool. They pull money from a whole bunch of investors. So here you are. You're right here you're in the top of the circle. They pull all the money of the investors, and you're basically giving it to a fund manager. So you're giving it to me in Wellington. Let's say if we have a mutual fund one day. We decide to invest in a certain pool of securities. We buy stocks or bonds or whatever the mutual fund. Usually it's stocks and bonds most of the time when you see. We invest in that pool of security, and that mutual fund has a certain value. It's tied directly to the stocks and bonds that we hold. Make sense? So the value of your share in a mutual fund is tied directly to the price or to the value of the stocks and bonds. Do you guys understand that? Okay. And basically, we generate returns for you. And those returns, we pass it back to you as the investor. That's a mutual fund. It's pretty simple. It's very straightforward. There's two types, open-ended and closed-ended. Closed-ended basically means that it's kind of like a stock. They issue shares. The closed-ended shares trade on an exchange. And basically, that's it. They're not going to issue any more shares. Yes?
Can you go back to the circle?
Yeah. That's funny that you mentioned that. No, I'm doing it for charity. Trust me. Just lend me your money and I'll take care of it for you. That is correct. Actually, mutual funds, they do charge fees. And that's one of the disadvantages. Obviously they have fees called front-end, back end, or front load, back load, depending on who you're talking to. They have management fees, and they have 12B-1 fees, meaning like advertising fees. So when you look at a mutual fund, yeah, you might see that it gives you a nice return, but you need to be aware that they do charge management fees. Front-end fees basically means that when you buy a share, they charge you a fee.
And also, it's important that you guys remember something, that if somebody comes and they may offer you, okay, so I'm going to get you 20% in 3 months, there's something wrong there. Because that's too good to be true. To be true. You guys have heard that, right? Too good to be true. That happens. Nothing is that simple. Nothing is that easy. I'm sure you guys have heard about Bernie Madoff, what he was doing. So really keep that in mind. There's something, a fact that is that it is too good. If it seems like it's too good to be true, it is. So always keep that in mind, okay?
Exactly. So yeah, you may get a return, and we're nice enough, and we're going to pull your securities, so on and so forth, pull your investment to give you access to other securities you wouldn't other have access to. But mutual fund managers don't do it for free. They're going to charge you these fees. So front end, you buy the mutual fund, they charge you a fee. Back end or back load, you sell the mutual fund, they charge you a fee. Management, obviously, it's a maintenance fee. I interned at I'm not going to say the name, but I interned at a financial firm, a very big one actually. And one of the products that they used to push on customers, or clients rather, it was in wealth management. So a lot of these clients had a lot of money. But even people that have a lot of money are not always sophisticated in knowing all the fees and how financial instruments work. And I remember one time, I had a client, or my financial advisor asked me to do something, and he's like, look, I have this client, he has these ETFs. I want him to get out of ETFs, and I want him to get into mutual funds, right? And I was curious. I'm like, ETFs are, I think, my opinion, a lot better than, mutual funds. So why would you want to do that? And he explained to me the fee structure, and the financial advisors also get, compensated for that. So not only do you have those fees, but let's say if you have a financial advisor who says, here, buy this mutual fund. Be wary that financial advisor is also going to get a commission. So that's going to erode away your returns. And that's, a problem. So, be wary of mutual funds. Anytime somebody tries to sell you a mutual fund, tell them, I want to see the fees. Show me the loads. Show me the fees. Show me the management fees. Show me the 12B-1 fees. And if you're going to ask for a mutual fund, there are low-cost mutual funds that are good investments, and there's some mutual funds that are no-load mutual funds that don't have any fees. So if you're going to invest in a mutual fund, insist on a no-load mutual fund, or consider the cost and try to get it as low as possible. Back in the day, mutual funds used to get really, really high fees, but now with the increased competition with ETFs, their fees have been shrinking little by little. Okay, so back to the mutual funds. They can be actively or passively managed. This basically means that you can have somebody like me or Wellington actively managing, picking stocks, adjusting the weights, timing the market, or they can be passively managed, meaning that we bought the stocks and that's it. We're going to let it sit and we're going to let it appreciate, and you can choose to sell it whenever you want. Okay? ETFs, it's an investment fund that tracks an index. And yes. Okay, open-ended, basically, the only difference between open-ended and closed-ended is that open-ended means that they can still issue shares, right? So closed-ended, they've closed off the amount of shares that they can issue. But open-ended, the shares are still open. And if you look at, obviously, a mutual fund that's open-ended, they have to buy back your shares if you decide to sell it. You can cash out that way. Closed-ended, obviously it's an exchange. It trades just like a piece of stock. Okay? Okay, so ETFs, they track an index. So if you see like the S&P 500, the Dow Jones, right? Those are indexes. And basically an index is, does anybody know what an index is? Anybody have a clue? It's a basket of stocks, or a basket of securities. So like the S&P 500 is an index. All these stocks here that you see that are scrolling along, these are all trading on the S&P 500, for example. Right? That's an index. Now, an ETF basically does the same thing as a mutual fund. It pools together investors' assets, and they basically issue shares, and you can buy them. to give you access to the market. So let's say if you want to buy the S&P 500, or let's say if you want to buy, the S&P 500 is what, like 600 right now? So on around that range, right? 500, 600, right? It'll cost you $500 or $600 to buy the S&P 500. Or you can buy the SPDR index, or SPDR ETF, which is basically, that instrument pulled together and they issue shares. It's the same exact thing. You pull together investors' funds, you buy the securities, and you issue shares. Same exact thing. Make sense?
Yeah, so basically, to put it like in simple terms, what an ETF does is that supposedly that you have an index, you have the S&P 500. That in the S&P 500, there are 500 companies, and each of those companies have a different weight. A different weight is basically how much of that company does that whole index represent. So what an ETF does is that basically they get all those shares in the same proportion that the index does. So for example, let's say that the S&P has 10% of the whole S&P is Apple. So an ETF, what we will do is they will get a 10%, they will they will buy Apple stocks in the way that it represents 10% of all the holdings they have. So that allows them to mimic the exact performance that those indexes achieve. Does that make sense?
Basically tracks the market. To let you see how it works, let's see, the S&P 500 right now, I'm looking over there, it's 1304, right? I don't like this. This is a problem. Okay, it's 1304 right now, right? Let's say if I'm a company that wants to issue an ETF. I'm an investment company, and I want to have a custodian bank that's going to hold the shares, so on and so forth, right? I want to issue 100 shares. If you as an individual investor wanted to buy each of the shares of the exchange, it's going to be costly, time consuming, you're going to have a lot of commission fees, it's going to be a pain, right? So some bright investors, financial engineers in the 1992, they came up with an idea, hey, let's issue an ETF that tracks the market. So basically I'm going to issue 100 shares, right? Divide this by 100, how much is each share? 1304. Now you as an investor, or as a saver, you can buy the shares for $13.04. And as the S&P moves up, let's say it moves up to $1,500, what's going to happen here as well? It's going to move to 15. So it tracks, these two track each other. The index obviously tracks the ETF. Does that make sense? So that's an ETF. Now, one of the things that I really like about ETFs, and even mutual funds as well, is that they allow you to diversify your asset base. So let's say, obviously when you buy one stock, what kind of risks are you taking on? You take on systematic, and the most important that you can diversify away is unsystematic, right? You have unsystematic risk that you can get away from. And the way you do that is by buying a basket, right? So what ETFs allow you to do, and even mutual funds as well, is they allow you to diversify your asset pool at a very low cost. Versus mutual funds, they can be a little costly, depending on which mutual fund you buy into. So that's how ETFs work. They can virtually track anything. They can track commodities. They can track gold. So if you want to buy gold, you can buy gold through an ETF. It's called GLD. If you want to buy commodities, you can buy commodities as well through an ETF. So whatever you want to invest in, you can do that through ETFs. Basically, the advantages is that there's no minimum investment. Sometimes mutual funds have a large minimum investment. Like there's one mutual fund that is really, really popular. It's called the PIMCO Total Return Fund. Does anybody have an idea what the minimum investment for that is? Keep going up. Keep going up. Wrong. $1 million. So if you wanted to invest in it, you would have to have a minimum investment of at least $1 million. So keep that in mind that, obviously mutual funds have minimum investments. ETFs, they don't. But obviously, the amount that you can invest in an ETF depends on the price of the ETF. So if you don't have $13, you can't invest in an ETF. Obviously, you have to consider your capital constraint. Okay? They're a great way to diversify at a low expense. And they allow you to alter risk-reward style. What does that mean? Basically, if you like to play around with options, or if you have a financial advisor that likes to play around with options, or any kind of risk management tool, you can manage your risk through ETFs and options. Mutual funds, you can't do that, usually. Mutual funds, you can't do that at all, actually. Disadvantages, obviously the price can go from 15 to 1304. Obviously you have to deal with price risk. If the dividend is distributed to you, you have to reinvest it yourself. Whereas a mutual fund, it automatically reinvests it for you. So with an ETF, you have to be aware of the distributions that you're getting in. And obviously you have commissions from brokers that you have to pay. If you buy it from like a broker, you have to consider those commission fees. But then again, if you weigh it out, obviously mutual funds have high fees sometimes, so you need to consider that as well. Let's see. Anything else? We already covered this. Mutual funds, some of the benefits about mutual funds is that prices are consistent in the sense that if you can't stomach the fluctuations in prices and you have like an open-ended mutual fund, that might be good for you because it's a psychology thing. It may not be the most cost-effective, but for psychological purposes, it may help you sleep at night. So that's something that you need to consider. There's no commissions for trades. They automatically reinvest your dividend, and they also diversify like ETFs. These are some examples of mutual funds like PIMCO, Franklin Templeton, MFS Investment Management. So there's different flavors that you can play around with. So Juan's going to go over asset allocation, and then we're gonna close it here.
So I'm gonna try to go over it as quickly as effective that I can, because also Dr. Simon, she's gonna be talking to you a little bit more about this next week, okay? But I'm gonna give you a brief introduction, so you have a better idea next week. Okay, so diversification. We have talked about a lot of diversification, about systematic and unsystematic risk. But what is diversification? Diversification is basically when you're able to control your unsystematic risk. For example, let's say you have $100, right? And all of that money, you put it in one stock of Apple. Let's suppose that it's 100, right? So you just put all of it in one stock. What happens if tomorrow Steve Jobs feels sick or he retires? That can have an impact in the performance of the company. And maybe the company go bankrupt or may something happen. So that will basically represent in you losing all your money. But what if instead of putting $100 in Apple, you have put 50 on Apple and 50 on Microsoft? That would allow you to, if Apple goes bankrupt, you'll still have your $50. So that's the principle of diversification, not putting all your eggs in the same basket. So also an important thing to mention is that all of the different financial products that Michael introduced to you, you can put all of them together to create a diversified portfolio. So, for example, let's say you have a different asset classes. You have stocks, you have bonds, and you have commodities, or whatever the case is. You want to try to mix all of these asset classes in a way that you can take advantage of that risk-reward relationship and the way all of them interact together. Because, for example, Mike showed you a graph previously about about this one. When stocks go up, bonds go down, for example, you see? So by having a mixture of both things, you'll be more stable. That makes sense, right? Instead of having all of it in stocks, and then they'll go down, you lose all your money, or having all of it in bonds, it goes down, you lose all of your money. You have a mixture of them, you're able to have a more stable performance. So I want to direct your attention to this graph. I think it's really important. And as an investor, we normally like stocks because we are more familiar with stocks. We hear them on the news all the time. We are familiar that normally they tend to provide the higher returns. But it's important for you to notice that by having a portfolio that is only stocks, you have that dependence on the performance of those stocks. And specifically here, if you see this point right here, is that the performance of the stocks. this graph, what this graph represents is basically the risk-return relationship. So you can see this line right here is the return. So as this line goes up, the higher the return. And this line right here represents the risk, which is the standard deviation. But so for example, if you were to have all your portfolio on stocks, you have this degree of risk, a 17 degree of risk, for an 11 degree of return. But what if you were to mix this, say for example with bonds? So if you were, with real estate, for example. So let's find the real estate is the number C. So let's try to find the AC right here, you see? So basically you have improved your level of return from 11 to 12.5 by taking less risk. That makes sense, right? Because this is what I've been telling you about how you're able to not put all of your eggs in the same basket. So what if you want to include a third asset class, a third different instrument that you can use? So let's say, for example, that we want to take stocks that are outside the U.S. So we will have to combine all three of them, right? This one right here is the ABC. You can see it's still a better performance than the only stocks, and you have a higher return for less risk. But then let's say that you want to do a four asset class. So you want to put different instruments, and now you will include the commodities. So that will be the point ABCD, right? ABCD, which is right here. So you see how you have been able, by including different asset classes, a lesser risk and a higher return than any other of these asset classes. So this basically gives you an example of how, by achieving a degree of diversification, you're able to get better returns and also take a lesser risk.
Now, to make a note of that, actually, a lot of people here, or most people that I meet, they just either have savings accounts or a CD and so on and so forth. So basically, you're taking on, you basically have one asset class. You're on the low end of the return profile, and just by diversifying your assets a little bit, you can adjust your risk-reward relationship to a very comfortable level where you're getting a good return over time, given the level of risk. So that's important to take advantage of. Diversification does miracles, because as you see, for example, ABCD, you're getting over 13% return, and you have very little volatility relative to that. So you have a nice risk-reward relationship. Yes?
The real estate securities here means investing in real estate, not the home that you live in.
Well, if you look at C, it's a FTSE Real Estate Investment Trust Index, you see? Remember what I mentioned, real estate investments and trust REITs that give you an income portion coming in?
It's not real estate that you own.
No, it's not necessarily, at least in this example. Yeah, in this example, we're looking at a real estate investment trust. However, real estate does have an effect on diversifying your asset pool. Because, at least for most of the last 50 years, it was uncorrelated with any other security. It just kept going up, right? But unfortunately, over the last few years, correlations have changed, so, we have to adjust for that. But like I said, we're just introducing the concept of diversification. So, you have a question?
Yes, sir. If I want to invest in these REITs, how do I go about that? Do I go to a bank? What is it? How do I do that?
Okay, so to give you... Okay, they're listed. A lot of them are publicly traded. So one that's publicly traded, it's AMB. You can go online and look them up. Look them up. I think this is an industrial real estate investment trust. If you look at the yield, it's 3%. AMB, so AMB Property Corporation. I'm not giving any financial advice. I'm not telling you to buy this company. I'm just saying that this is an example of a real estate investment trust that you can buy. However, one thing to note is that real estate investment trusts over the last year and a half, 2 years, they've had a rally. Back in 2008, they got hit really, really hard, so it was awesome to buy them. And now they've rallied. You would have made so much money. But obviously, if you want to have them for the yield, it's a nice yield. So you can take on that. Or if you look at that this is KMP. Like I mentioned, almost 6% yield. This is an example. Once again, I'm not telling you to buy this. I'm just giving you an example. So here. Oh, yes. To answer your question on how you buy it, all you have to do is you set up on your brokerage, whoever uses your broker, you just go online, and you just submit the quote. If you set up an account, then you just go ahead and submit it. Boom, 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 and you just put the order in. Scott Trade, TD Ameritrade, so on and so forth. Any other questions?
Yeah, so but to make it clear that maybe it hasn't been clear enough, that for example those REITs, what they do is that normally, for example, you have a construction company that they are in the business of developing residential condos, and they have residential condos in Miami, in New York, or whatever the case is. So you're basically buying part of that company and those buildings that they have developed, those pieces of real estate they have developed. So you're investing in real estate by acquiring a piece of the ownership of these kind of companies. Okay.
Like a mutual fund
For real estate. Okay. So that you guys have an idea of what is it that they have. So when you start looking at yourself, when you start looking at who you are and what you want to do with your money, it's important for you to consider these different aspects. It's important for you to really know what is your objective. Am I investing to buy a house? Am I investing to pay for the education of my kids? Am I investing to take a trip in a year? It's really important. And once that you determine that objective, you need to stick to it. Like Michael said, say you have, for example, a loss and you want to, okay, I don't want to be in the market anymore. I want to take all my money out. You're going to have to